Share the speaker's profile?
Yeah, speaker profile or our flyer.
Our flyer. Okay.
Flyer. Yeah. I think before starting our session, we can discuss some updates about the new examinations for valuers. Now it is going to be like every 2 months only, once in exam. Like if any failure happen, again we'll get it only after 2 months. The chance. Anybody is having idea whether it started now or it is from September onwards?
The
New examination
had
rules.
come 6th June.
It is after 3 months from the date of notification.
Yes.
Maybe even we don't have any update on valuers bill also. I think see, in the valuers bill they are suggesting like it is like a profession, 3 years profession like CAS. Even once the body is set up, we'll be knowing that new valuers guidelines examination rules. Anybody is having idea about any valuers bill? What is the status? Can we start, Shilpa?
Yeah, you can.
Actually, I'm just waiting for the speaker to join. He'll be joining anytime now. Just 2 minutes.
Before joining speaker, some updates from our Bangalore Valor Association. Good morning, all. Thanks for joining Saturday session. I welcome new Bangalore Valor Association members. This week, almost 10 members joined. I request other members also to encourage other registered valuers to become members. Then our strength will be more. Then we will get motivated to conduct more sessions. Even committee is now looking into sending mails to registered valuers to join the BVA. Maybe I request all other BVA members who are the BVA existing BVA members to encourage to spread a word to join as a members. Feel that okay, you are also a committee member, and even we need not like we are also registered valuers, but all members to request okay to spread a word to join. Now we have almost 160 members across India. Even at least each member, 2 members or 3 members, if they join, then it will go the strength to 400 to 500 members. Then we'll get more ideas and more encouragement to conduct more sessions. Even I request from all other members also to give topic suggestions and allocate speakers also. We are looking speakers, and even we are looking some volunteers. Even we want to send newsletters once in a quarter at least. If any member is interested, please reach out to me or Shilpa or other committee members. We can circulate newsletters which are important to SFA valuers. And even we are going to conduct joint sessions with ICA and ICMA, ICSI in near future. We are having discussions with them. We may conduct these sessions online also, both physical and online. Shilpa, is speaker joined or?
Yeah, speaker has joined.
Yeah. Today, note okay how to estimate beta. As you know that beta is a variable we have few variables in our valuation. One is the weighted average cost of capital and beta and growth, and which plays a vital role in your DCF calculations. As you know that beta measures the stock movement. If beta is 1, the stock will go appreciation as per the market return. And if beta is less than 1, even if the market goes up 10%, the share price will go only 5% up. Even if the beta is more than 1, the share price fluctuates while volatility is more. Very, very important concept to today's beta. I thank Shilpa for organizing this session and organizing the speaker and identifying the good topic. And I thank Jivika also for coordinating with the members and again doing the good role in getting new members also. And I thank Vijaya also to provide all help in getting members as well as helping members in registrations. With this, I hand over to Shilpa to take.
Good morning, everyone. On behalf of Bangalore Valuers Association, I would like to thank Bhuna Raman, who had suggested this topic and introduce the speaker to us. It's my privilege to introduce today's speaker, Mr. Rajiv Singh, to all of you. He's an expert on business valuation, banking, corporate finance and strategy, M&A and restructuring, forex risk management and international controls, and has experience over 15 years in valuation. He has been a speaker in more than 800 seminars and training programs on valuation, banking and finance related topics at different professional and industry platforms, including IIM Bangalore, SBI, various other forums. And I'm really happy to see his lengthy privilege, as you can see. I would like to forward his profile in the chat just for the participants to have a better understanding of our today's speaker. Sir, over to you. This being a CPA session, we'll be running the polls. Sir, please let me know as and when a poll question has to be run. Over to you, sir.
Okay. Am I audible, Silva?
Yes, sir.
Okay. So good morning to all of you. I've never been used to 7:30 morning programs. Thank you very much for inviting and forcing me. 7:30 in the morning. Yeah, late night programs are there, habitual, but morning program 7:30 probably, as far as I recall, this would be the first one. So thank you very much for all people who have connected today. And in the morning, I can see how agile and awake people are there. Interesting. I think we are focusing on topic, something which is very important, and the way we do is in a very mechanical fashion. So I'll try to address in 2 hours. I'll keep this as an opening and give you some of the ideas which probably would be very important when you focus on assignments. To give you overall perspective, in India, most of the cases, I would say, we are too mechanical, right? When we calculate beta, we do hardly any analysis. Whatever the data set or database which we use, we calculate, and whatever numbers comes in, we accept it as a number, which we don't have to focus much on. But that's not the international scenario is, and based on my experience on various international courts, especially in arbitration setting, I can tell you that every element, including the beta, is tested, contested, right? And you will be attacked. And it has a huge implication. So there are a lot of development happening in these areas, especially the way you estimate your cost of capital, and the beta has to be one of the key components. And when it comes to, especially for startup companies or new companies, how do you do that and how you progress into that? So what I've done is mix of both, because I firmly believe that the sound foundation in finance is very important if you have to defend your work. So what I'll do is I'll focus some portion from practical segment and then back it with the uh, uh, well-known finance concepts to support and substantiate what we are doing in our day-to-day activity. So how I will proceed is I'll just give you an idea. I'll just show you first few set of beta computation and some numbers. I'm sure because this is a platform where all of you are. I've just seen, including when I was getting into this Zoom meeting. It asked me to provide my registered value number. So I'm I'm presuming that nobody else can come in unless you're a registered valuer. So all of our registered valuer and are very much aware that what our responsibilities are and what are the expectations of the society and of course the regulator. So considering that aspects, I'll identify the pitfalls and suggestions and solutions and diverse practices where you don't find answer for. If I'll be able to do that, I think I'll be very happy at the end of 2 hour session. But in between, if you have some questions, always keep on asking those questions. So what I'll do is I'll just take you through first a few slides, which will show you some numbers. Maybe you would have seen it or you would have basically learned somewhere else. At the end of the day, objective would be, after looking at those numbers, that what are the inferences we can draw from and what those numbers indicate and how do we proceed if the numbers are before us, and what will be our conclusion when we go and do a valuation assignment or perform a valuation assignment. And after that, I'll give a little bit of theoretical background, and then through that, the next focus would be to bring more practical inputs, which we face day and night when you calculate beta. And then again, we'll go back and see whether those numbers which I'm starting with today, whether you are compatible with or not. If we are able to understand the whole game, I think 2 hours would be very important for us to basically understand the overall mechanism and of course implications and valuation aspects. So I'm keeping both the legal part, the transactional part, and the conceptual part. So I'm just loading my presentation. Am I allowed, Silpa, that share screen side? Can I
Yes,
can I
sir.
do it from my side?
Yes, sir.
Okay. So you just have to tell me, is that visible?
Yes.
Right. So now what we are looking at, just look at these numbers and then I'll come back. As I said, we are starting with these some numbers. Few slides will run through. Some of them we are aware, some of them we might not be, and you might have not seen those numbers, right? After that, once we'll visit these numbers, then we'll come back and try to understand what these numbers indicate and what are the implications as far as calculation of beta is. I've taken some live data and you can see the date. I just prepared it for this program yesterday night, right? So I picked a few companies in real estate segments in India. Now I'll ask you that which beta I should use in my evaluation assignment. So I'm giving you a number of a solution. All are equally valid, and if you ask me computationally, they are all correct. There is nothing wrong into this. So which one I should use? Why should I use? What will be the implication? How it is going to change? And what are those variables which is going to affect it? You can see it. What are the variables I'm changing into this? I've deliberately kept some companies, in this segment, which has a different ramification, even though these companies, form part of the real estate segment. So when you catch what is called as a comparables and comps, in short, you should be very careful. So what are the variables I'm changing? You can see this slide has got three basically a calculation of beta.
Slide is not clearly visible, sir.
Sorry.
Slide is not clearly visible. Can you increase the resolution?
Okay.
No, it is visible. I think it is.
It's visible. Maybe you can adjust your screen a little bit.
Only the font size is small.
Yeah, I've just kept it font size. You should not worry because I'll be this slide I can share with you. Just understand the concept. For font size I kept it because I want to show you on the one slide, 3 component. Then we have 3 more slides, and then you can see, just have a numbers. Some numbers are appearing, and after that I'll explain those numbers. So you'll become very comfortable with this, right? So what I've done is that I've selected few companies from real estate segments, and those companies are all known companies. It is there in the Indian market, and then as an index for calculation of beta, I've taken Nifty 50, right? So this first 3 calculation with comparison with the index known as Nifty 50, right? But you can see I have changed the frequency. So one is coming with a monthly frequency. That means to calculate beta, you require a return, and return of the index you select, and then of course the return of the security which you select. Now, what should be the frequency of those? Should it be monthly? Should it be weekly? Should it be daily? There could be a lot of audit queries also. In an international platform, a lot of people ask a lot of questions, half cooked and not something very clear to people that why I'm doing so. So the objective is to show you that if I keep one index, right, and just change the frequency, my beta's number for the same period, you can see it is a 5-year period which has been taken. For a 10th June 2020 calculation, we've gone back to 10th June 2017. So this is called a look back period. A look back period is how far you want to go in past. So that's what the look back period is. The indices which I have selected for this slide is Nifty 50. And you can see the monthly, weekly, and daily is the frequency I've used, right? I'll come back and explain you that what is the best practices, how do you make a solution out of this. But the first objective is to show you the number, right? So we have the beta calculation. The first row shows with the levered beta. That is nothing but that equity beta. You always calculate a levered beta when you use characteristics line to assess the beta, right? Then you also have one more calculation called adjusted beta. Now, this adjusted beta and more famously known, there are 2 set of adjusted beta calculation. One, you can say that it was Marshall Bloom, which has been adopted by Bloomberg, right? So that adjustment is a pretty mechanical adjustment. This adjusted beta calculation is a Wozniak adjustments. We'll discuss about that when we require, why we require, or whether we should ignore it. And then there are 2 statistical numbers there. One is R-square numbers and another is the standard errors. Now these 2 are very critical as far as calculation of numbers are concerned. Can you see it here? When I look at those numbers, how much the data has gone changed from monthly to weekly to daily. Now the question would be, should we then go and select the beta of these companies, whatever the purpose of the valuation is, on a weekly basis? Is that the right one, or a daily basis the right one, or the monthly basis, right? So the one number which we will discuss, and I'll explain you what basically we infer as a finance professional, is the R-square number. So in a literal sense, or in a in a very simplified version, R square numbers will tell you about the strength of the beta. So in a very simple and a layman's explanation, I would say higher would be the R square number, higher would be the strength of the beta. When I'm talking about strength of the beta, which means I'm talking about the predictive power of the beta. So that number can move from 0 to 1 or maybe from 0 to 100. So if a 100% R square number is there, which you will find rarely, which means that it has a very high predictive power and therefore should be accepted. So a lot of people, including I'm saying audit review team, maybe when you are facing crossfire in any kind of a legal setting, when you go for evaluation, people say and then focus too much on the R square number. Now, R square number also has a lot of linkages. This is what my objective is to show you with the kind of index you have selected. And R square number is not the only number to tell you the strength or predictive power of the beta. R square is basically is a more pampered baby, is more highlighted and a statistical number, whereas people believe that this is what it'll tell me that this beta has a very a strong predictive power, whereas the other statistical number, which again does the same thing, but we generally tend to forget, is the standard error, right? And it is absolutely it is a very important understanding if you have to understand the beta appropriately. So to recoup the concept, R square number, right now we don't know what this number is, but something which gives me a higher, I'm just inferring as a layman, if these numbers are higher, which means the beta has a higher predictive power. The reverse is true in case of standard error. So if the lower is the standard error, right? So we have a more reliable beta and there will be a low error, estimation error when you estimate cost to equity capital, because ultimately your objective is to estimate cost of equity, and which might be a situation where you can go and input that thing in weighted average calculation, cost to capital, or where. The question is that which one is to be relied, and how do we get into this? Both R square and standard error both have the same role to understand the predictive power of the beta. The difference between these two in a layman's sense is the R square number is just telling you the kind of a change, like a vehicle running on the road. If you say that the vehicle speed has moved by say 30% or 40%, you have absolutely no idea that whether it has moved from 20 km per hour or whether it has moved from 70 km per hour by 30%, right? So this is just a relative changes and show you a concentration. So R square numbers are like that. It does not tell us the exact distance from the way you draw a regression line while we are calculating a beta, right? So we all know that regression line role is regression line basically passes through by connecting maximum points, and therefore any points which are deviating would be an indicator that these things we cannot predict. A standard error basically indicates about that. The question is that if we have a big deviation or a big standard error, which effectively means that you have a less reliable beta. So the question arises here that if my standard error is very, very low, right, which effectively means your all data points while you draw data for the calculation of beta, and of course you draw on x-axis returns for your indices, and on y-axis you draw return from your from a particular selected security. For instance, here you have seen on the screen there are a number of companies. So when you draw these numbers And if there are very few deviated points from the regression line, the line passes through connecting maximum points. A lower standard error is a vertical distance measured from that regression line. So therefore, this gives you an exact in terms of a kilometer, that if it is say 20% from the stage of 70 km per hour. So therefore, a standard error is a more appropriate, measurement of your levered beta estimation as far as predictive power is concerned. The another important point is that remember, R square numbers will not help you in telling or you can't infer from R square number how much error will happen when I estimate beta using the number I have calculated. Whereas the standard error, because it is a vertical distance measured from your regression line, will tell you that what is the standard error impact. That means the impact on my estimation of cost equity. R square numbers are not there. So what our job would be, some cases your identifications will be much easier, in a sense that here we can see, you can easily identify whether I'll be able to monthly, weekly, or daily. And also looking at your R square or standard errors numbers, you'll be able to substantiate that this is the beta which is more appropriate. For instance, in this example, you can see here R square number for monthly calculation versus R square number for your weekly calculation. And you can see in most of the cases, the standard errors numbers, if you look at and compare them, it will help you to basically predict the beta part of that. So whether I'll select daily, weekly, or monthly, that depends upon the number indication of R square and standard errors, right? So once we'll go through and change these numbers, I'll give you 3-4 indices and then come back to explain this concept in more detail, because what is being seen here right now on the screen is a calculation, the number from where those numbers are coming and how do we interpret and understand is a very important aspect. So now what I'm doing, I'm changing from Nifty 50 to BSE. Generally, you see Bombay Stock Exchange, one index, if I select Sensex versus Nifty, that is highly correlated. And thus the general perception is that the beta calculated by whether Sensex or by Nifty will not greatly deviate. We have the data, and I'll prove you in one example. There could be a multiple research into this area. You'll see that there will be a deviation, and there are reasons for that, because the indices, what we call it as a Sensex and others, are dominated by few stocks, right? And that is a very critical aspect. If it is those stocks are dominating the Sensex, it is quite possible. I repeat this because this is what the one I'll show you the formula, then I'll explain more. But at this stage, it is very important to know if the Sensex is more dominated by, say, take example of a banking company, right? And if you are in a manufacturing company, it is quite possible and more likely, though, that your beta estimation will be very low. This is very important. So if you have not understood the composition of indices, right, remember the basic concept of estimation of beta is a market portfolio. So the theoretical connotation talks about a portfolio consisting of all risky assets. We are focusing on a concept called a proxy market portfolio. Now, if the proxy market portfolio has a problem in a sense, it's dominated by only few players, it is quite possible that those stocks which are not in the line with the indices will be not that much in correlation with the index movement. As a result of that, this is a very, very difficult proposition for people who are doing a mechanical job. They are not interpreting, they are not understanding what they're doing. The result would be that because of the lower correlation, your standard deviation, your beta numbers would be very low. And you'll be very happy. And sometimes you'll be wondering also, sometimes I ask people that is that the risk of those stocks has gone down? The answer is no, but you have no way to understand that why the risk or the beta is reported low. It is reported low because it is not correlated. How do you know? So you have to go and see the component part of the beta calculation. So I'll come back and explain that aspect, very important for us. One is about the understanding of indices, use of a correct indices, then about the frequency, and the third important part is how far we can go into the past. Then fourth important point is that how do we use the R-square number and the standard error to understand this aspects. And then of course, we'll also have to focus on what will be my sample size, what kind of a company I can take, and those aspects. So I'm just moving back to the next slide. Can you see I have changed the Nifty 50, to S&P Sensex.
Sir, we are not able to see the change slide. We are stuck on the slide one that has been reflected. Am I missing something?
No. Now we can see slide 4. Now it is just now.
Yeah, it takes time. That's the technology issue. Okay.
Sir, is this data coming from some software or we can procure it from the NSE BSE website?
You can this is I've taken from Capital IQ, but you can always you can develop. I'm coming back to that point because whatever we have seen, even the people who are using database, they do not understand what the database is doing, and then you have a serious problem in your numbers. For instance, when you're using a Capital IQ, right now I'm not showing you here, it requires a for this calculation, especially if you go for an unlevered beta calculation. So right now it is a levered beta, there is no problem. Once you go for an unlevered beta calculation, so you have a setting there in the tax. So what should be the tax? Guess. So what the Capital IQ does, it takes a 5-year average tax, reported tax, right? As a result, you can see a wide fluctuation in the tax rates, and therefore your unlevered beta calculation will be wrong, right? The way you calculate the cash flow, most of the time you will try to address the impact of losses and etc. outside your cash flow mechanism. So it should be a marginal tax rate. So you need to manually change, and if you don't do that, your unlevered beta estimation itself will be wrong, and you'll be happy that, oh my god, I'm using a very reliable database, but the database is giving you flexibility. You need to understand what you are doing. So right now there is absolutely no problem, but you can see that a difference here in terms of by changing S&P BSE Sensex. Basically this is a 30 index index as compared to Nifty. If you ask me, based on capital market theory, Nifty 50 is more scientific as compared to Sensex. I repeat this word, more scientific, because it has been testified, it has been checked with for your in practical life. Of course, we never get a full diversification, but it is a well diversified portfolio. Well diversified portfolio characteristics is that if you add more stock, there will be no further diversification which you can achieve, right? So Sensex is a traditional index, 30 index. It has not been tested scientifically, but since Sensex and Nifty has a strong correlation, for some stocks, you will not find a greater differences in terms of beta calculation. But some other stocks, as I explained you, where there will be a big differences in terms of your movement. So you need to understand the index composition. You also need to understand the industry where your stock falls in, for which you are calculating beta, and then you will be able to understand the calculation of your levered beta and unlevered beta. So here also you can see as compared to monthly. You can now see weekly has a more strong R square number, and then of course lower standard error. Very appropriate and adjustable, acceptable in a situation is when you have a high R square number and a low standard error. But again, recently, one instance I can remember when in Qatar, we were doing, of course, Qatar is now more famous last 2-3 days, but recently in one of the very interesting case, we were doing some assignments, and index used was MSCI index, which most of the cases you would be forced to use because the domestic indices will not have that the characteristics of market portfolio as defined by the inventor William Sarr. So what you do then, your R square numbers are going to be low, your beta also is going to be low. I'll show you when I run this, and take example of DLF is widely, this company has got a good volumes and gets reported. You can see here the numbers are 1.41 is for a monthly something, 1.62 something on weekly basis is coming. But what you have to focus on are square number and standard error. Now what I'm going to change now, that there is another S&P BSE, not the Sensex but the 500. So look at that. This is a more wider composition of stock. Don't think this way that if you have a more number of stocks in the index, then the beta calculation will be much better. It's not necessary. 500 index, of course, what has scientifically been found after this 50 Nifty 50, that means the 50 stock selection of indices. After that, if you keep on adding, there is no much impact on your diversification part. That means diversifiable risk cannot be further diversified. So it reflects whatever left out is unsystematic risk. So, but then there is this impact. As I said, these all Indian indices, including Nifty and Sensex, which we blindly and conceptually believe that these are the indices which truly reflect the characters of I would say the macroeconomic factors, in a sense that it should conceptually should have only macroeconomic risk, but they do not. They are more dominated by few sectoral stocks. As a result, the beta calculation is not what one would expect in those kind of situations. Sometimes it will be understated, sometimes it will be overstated. So you can see here the numbers are changing as far as beta calculation is there on a 500 index, but the R square correlation is now has improved. If I just focus on the DLF, right, the beta number has gone different pedestal, and the standard error is very low as compared to what we have seen in earlier cases, and that is a better exhibition in this example. I'm not saying in all. So this is for S&P BSE 500 index. Now I'm using you. This is what you'll be forced to use in some international, assignments. Most of the cases, to give an example, like any Middle East countries, their local indices are not, I repeat, they are not even close to what we call it as a market portfolio, and they should not be used. In India, we are using, but there is, as I said, there is a lot of biases involved in this indices, and as a result, the beta estimates are not as appropriate as should have been there. But then as a practitioner, we are blindly following it. So you can see it here, the correlation. Now, this is a very important point. R square number, I'm just repeating this. When you focus on this, the first important thing, and then you'll be really shocked. Can you see now the DLF beta, how it has fallen? It was in the range of 1.41, 1.61, 1 point something. Now, the moment I'm using MSCI Emerging Market Index, and please appreciate conceptually, if you ask me capital market theory or CMT, what we call it, this is more reflective of or very close to the market portfolio or proxy market portfolio, and truly capture why it is happening is that it shows that the correlations are would not be of that level there as compared to what we have seen in Indian set of scenario. So when you are forced to use MSCI Emerging Market Index in some situation where your local indices are not very appropriate for the purpose of beta estimation, you should be ready to accept. I repeat this point because a lot of people say that I can't accept a R square less than 10% or R square less than 20%. It is not a correct reflection. So you have not understood what is happening. Here your R square numbers are going to be less because this is not a one. This index is broad-based index. Of course, India is one of the Indian stocks are one of the component, but there are other stocks, and therefore, in today's political and geopolitical or macroeconomic factor, you can see to say that you're not correlated is not correct. So they are coupled in the market, and this reflects you the true picture. But can you see the change in the beta estimates? Huge change as far as use of indices, and that's the eye opener for us. This is the area which we need more research to understand and to educate people to know this, that yes, this is what is going to happen, this is what is the implication. So if this kind of a situation can be just imagine if this is presented before a jury or before a person who have no background in finance, what would be his reaction? He will understand that, oh, this is what you have done is something a very fluctuating. There is no fundamental, and that's the reason why the numbers are changing, and we need to defend it. The question is that which one is more appropriate and what I should use it. My only submission is that when you are using say international indices, especially for a small economies. I'm not talking about the large or developing or large economy. If you are using that, it is very likely that your R square numbers will be low and your beta also will be low. And as a result, your cost of equity estimation will be low. So you need to compensate by something called alpha, that is a company specific risk premium. And why it is low is that your stock might not be correlated with what is happening across the globe. Now, your question would be that in this case, should I use the MSCI Emerging Markets Index, or should I use for this set of companies, say, the local indices? My answer is here, and this is very interesting. Even a company like Ansal Properties and Infrastructure, can you see that? Where it is clearly reflected, because I have before coming to this program, I have studied all the balance sheet yesterday night, right? So I have not just taken these numbers for you and then I've started this program. I've studied all the balance sheet and then came before you. This is a highly levered firm, Ansal Properties, and has got the highest level of debt in the market, right? And almost at the verge of default. And see, please appreciate the formula which I discussed with you will not captures does not capture the impact of chances of default, and that's the reason why the levered beta equity is very high. So what it indicates is that because these companies function majorly in India, I repeat this point, these companies function majorly in India, and as a result, there would be more, their macroeconomic risk would be more reflected by what is happening in India. Yes, long-term impact is there from international market, but that is a lagged effect. So there is a solution for that. We'll come back on for that. So it will be more appropriate to use the domestic indices even though it is, it is not a case where the real estate sectors do not move in that direction as compared to S&P or the domestic indices. So if I go back, can you see here Ansal Properties beta is 2 and something like that on weekly basis. And if I go back here on the Nifty, you can see the changes from monthly. Look at the swing from monthly to weekly and daily. So it is almost half and half and half. So the question is, anyone who wants to misrepresent, I repeat the word, anyone who wants to misrepresent without understanding the strength of correlation and standard error will twist the estimation cost of equity cost estimation. Why this daily for Ansal property is absurd 0.45 because of your correlation. It is just 0.01. That is no correlation. Effectively, if you ask me, it is not correlated at all on a daily basis return. So this will be very unfair, and it will be inappropriate to use that. In fact, even on weekly basis, this is not very appropriate. But if you can go for on a monthly basis, in case of Ansal property, it reflects so, right? Whereas the reverse would be case for other situations. For instance, in case of DLF, you can see is the monthly R square numbers are 37%, whereas it is 44 and 42% on daily versus weekly. So DLF on weekly basis is more appropriate because 44% of deviation, as a layman's sense, is explained or can be explained because of the macroeconomic numbers. Of course, you have to also see, as I said, more appropriate measure of predictive power of beta is not R square, but the standard error. So that was one takeaway from this discussion, because R square numbers will never tell you that whether how far or how far those deviated points are on regression line from the regression line, whereas the standard error will tell you that how far it is and where it is concentrated. So it is not only important that you are concentrated, but it is also important that it should not be too much deviating from your regression line. If it is deviating too much from the regression line, which effectively means that it has a less predictive power. So I'll show you when we go for a more conceptual part. But in some situation, you will have no option but to use international indices like MSCI, Emerging Market Index. Sometimes you'll be able to use the S&P Index 500 for US companies, or maybe some companies as a international dimension. So you will absolutely see a picture coming totally different. It requires a lot of analysis before you even select what should be the right and appropriate index. There is no set rule that, yeah, if you are an India operating company, you should always use India. No, if your companies are having a businesses outside India are getting affected from other economies, MSCI Emerging Market Index will be more appropriate as compared to what is Nifty, and you can see it here, the results on those parameters. So now I'll explain you what I was stating you, the conceptual part. So we'll focus 5-10 minutes on the conceptual part. And when I talk about conceptual part, I'm going back to the basic understanding of capital asset pricing model, or how it is pronounced as CAPM. And you can see it here. This is on the assumption that investor holds, same risky assets called market portfolio M. And this definition of market portfolio is all risky assets. I repeat, all risky assets of entire world. Okay, so that broad definition is, when we reduce that broad definition to a very small, it's like understand if we have a very can I go and then restrict the size of a god? The answer is no. But we have a small institute of a god where we say this is a proxy, and then I'm praying and I'm believing there is a God. So it's like, market portfolio you are using as a proxy as compared to what has been assumed in the basic definition. But if the proxy is dominated by only few stock, then your beta estimate will be throwing numbers which will be unreliable. And sometimes we are, if anybody applies mine, I repeat, if anybody applies mine, sometimes we do not, because we believe that yes, some database agencies, I'm not criticizing them, but that's their problem. In India it is there, like Capital Line, that they always give a beta on daily basis, right? They don't have an option to calculate on monthly or weekly. But can I do so on my own? The answer is yes, if you are supposed to. No, if you want to roll your DCF calculation in, a lot of people are saying automate. What do you want to automate? Automation is not the result. Automation only helps you in doing a speedy calculation, but then ultimately it requires analysis, it requires inference, it requires a decision-making exercise. So if you want to do a quick and fast and use whatever numbers coming without even understanding why it is happening, you are going to face the music. So you can see it here. The market portfolio definition is one which consists of all risky assets of the world. So there is no that kind of index. And of course, there is as I said, you've seen in this real estate company have deliberately chosen, because most of them have operation in India. They are affected by the Indian economy. And of course, Indian economy would be measured through the movement in the indices. There's no doubt about that, right? Of course, if you try to find out, they less move, if you ask me frankly, they less move based on what is happening in India. They more get changed. You can see the more changes happening in an international market, and that market could be US, it could be Europe, or it could be Japanese and some other market. And that's the reason why people are glued to CNN and some other channels in the night, and in the morning they see the market is going to change. So there is a difference between the economic fundamental changes, and there is a difference between changes happening in the market. So market may not reflect the true character of economy the way we perceive, and especially if it is a very small company or medium company, the situation will change. So can you see it here in beta calculation is as a formula? It is very simple. We just need to find out covariance. Now the covariance is a statistical number. It only measures, right, the co-movement. So co-movement of two series of data, co-movement of two people, there is a behavior. We are trying to understand the behavior. So how you will understand the behavior? You require a long period of time to understand behavior, right? What is this long period of time? We'll try to address that, because without that, I will not be able to understand the behavior. But please remember, covariance, how it will tell us about your behavior. It will tell you our behavior by throwing signs. The numbers which we get while calculating covariance has got no meaning. I repeat, the number what we get by calculating covariance gives us no interpretive significance. There is no interpretive significance of the numbers. What is the significance of covariance is the signs, whether it is a plus sign or a minus sign or a zero. All these are indicator that where it is relationship is there. And if it is so why we take a 5-year data, I will discuss about that. Why we go for a 5-year? Because 5-year on a monthly basis, you have around 60 data points, right? And that covers a one economic cycle typically. So we go there and try to find out, yes, this is what my covariance is. But remember, the covariance only talks about the relationship, does not tell you about the strength of the relationship. This is very important. So the strength of the relationship will come with a correlation coefficient. It is both measures the co-movement. The one gives you an absolute number, the other gives you the number what is only a sign. That means, but the strength will come through the correlation. So can you see when I convert this covariance formula, and I can see it, I'm now interpreting the beta. I'm now interpreting the beta in a way, in a very simplified version to explain you. It is a standard deviation of the stock multiplied with the correlation coefficient of a stock with the index which you selected. As I said, the objective of correlation coefficient is to tell you the strength divided by what is written is the sigma m. That is a basically is a if I go for a literal meaning, it is a standard deviation of a market portfolio or proxy or Sensex or Nifty. But remember, by definition, this should have only, I repeat, by definition, this should have only macroeconomic risk. That means a systematic risk, no unsystematic risk. So to the extent, can you see in the formula, to the extent your index is not reflective of the market portfolio, your estimation of beta will be incorrect. To take an example, Sensex is going up, but if your company is in a sector which is not dominated, not reflected a big weight, or there is no weight quite possible in the indices, what will happen? Your correlation coefficient, what is there in the numerator in the formula, will be lower. And if the correlation coefficient is lower, which effectively means that your beta numbers will be lower, does not mean that the company risk is not there. So to tell you in that situation what will happen, my estimate of risk will be understated. As a result, my estimate of required return on those will be very low. So I repeat this point. If you can read this, the interpretation of the beta is standard deviation of a stock is reflecting the total deviation because of both type of situations, macro as well as micro. So systematic as well as unsystematic risk is captured in beta. If you multiply with the correlation coefficient, right, this number is very important. So when you do your own calculation, your correlation numbers also will come, and then you will be able to infer the beta in a much better manner. So what I'll do in my numerator, suppose my standard deviation is 10%, correlation coefficient is say 0.70. So what I'm saying, 7% is because of your macroeconomic risk. I'm dividing with not the standard deviation. It looks like in the formula standard deviation, but by definition, market portfolios are the one which does not have any component of your diversifiable risk. As a result, it should have only macroeconomic risk. So what I'm saying, the numerator is capturing, converting total risk into a macroeconomic risk by multiplying with the correlation coefficient, and denominator also is dividing, doing the same thing. It is a macroeconomic risk of market portfolio, because market portfolio does not have any unsystematic risk. It always has a systematic risk. So in the formula, what is there? Systematic risk of security divided by systematic risk of market portfolio. That is why we have a relative measure. So to understand this formula is very important for us, especially the correlation number, and that you will be only able to know if you understand the composition of market and if you are able to understand the sector in which your company falls in, and accordingly you can go and move. But of course, there are a lot of trouble in selecting which sector my company falls in, which subsector my company falls in, because sometimes sectors could be broad, and your subsector in which your company perform could be something different, and can have a absolutely different behavior. So how do we address that? Also, I'm going to discuss on those points. Now, this is what formula of CAPM is, and you can see here the beta numbers comes from a characteristics line like this formula. So I'm not focusing more onto this. Another important aspect which I want to discuss about beta part is that should I regress? This is very important. Sometimes your results will be too much of a variation. That should we focus on excess return should we focus on access return or should we focus on the raw numbers? So let me explain what I mean by that. When we regress number, when I'm calculating return of say Sensex, when I calculating return of say TCS stock security, these numbers are raw data, right? So I can regress using raw data, which means return of say Sensex or Nifty on x-axis, and then return of your of the say TCS on y-axis, I can still get the beta, right? So this is a raw data calculation. Theoretically and conceptually, if you ask me, it should be based on access return. And why it should be based on access return? Because in case there is a big change in inflation and there is an impact of inflation, your macroeconomic risk estimation, that is nothing but beta, which is a relative measure of macroeconomic risk, will be inappropriate. But in large number of cases, whether you use access return or whether you use your raw data, your beta estimation will not be too much of a difference, right? And I can show you through this that the conceptually access return is more appropriate. In practical sense, why a database agency and sometimes we as a practitioner don't use that access return, I said there, because the difference in calculation of beta will not be very significant, but in certain situations it will be very significant. Let's see what is the idea of saying that it should be an access return. Can you see here in this formula? You can see this is a characteristics line y is equal to a plus bx formula is starting with the access return. So access return is a return on security less your risk-free return, right? Is equal to alpha plus beta, and then you have an excess return of market portfolio. So RM minus RF plus EI is something what is reflected is a return due to your unsystematic risk, right? From this formula, I can derive the formula for capital asset pricing model. So that gives you a sense that from where the original results are coming and how do I derive? Because this number is basically called this formula y is equal to a plus bx plus c format. That means an access returns is regress. Access return of security and access return of the index rather than the raw data is regress on the regression line to find out a relationship of a straight line. Appreciate that this is the actual component. That means I'm giving it 3 separate bucket to the total access return, and that is my 3 important bucket. The question is, can I forecast all 3? The answer is not. The first is I cannot forecast EI because that is something not on the straight line, and in a layman I can understand these numbers or these data points are not the regression line, they are deviation from the regression line. You can't predict that. So when I convert this the actual equation of access return of a security in expected modes, when I say expected mode, that EI number will be 0, right? So this is just a simplification where capital RI is representing your small ri minus rf, that is access return. So you can see these numbers will be now looking like that. Can you see it here? Is that visible? Expected return now EI is gone. Why it has gone? Because you can't predict something which is not on the straight line. So in expected mode, EI has got no value. Mathematically, expected value of EI is 0. Now the alpha is something which is a irrespective of what is happening to the Sensex, if some company is making a return, so this alpha gives us. Now over a long period of time or under the assumption of capital asset pricing model, and a stock cannot remain under overprice for a long period of time because of a phenomenon called arbitrage, and therefore they will quickly come back to a situation where your expected return or required return will be equal, and therefore the alpha also will go 0. So can you now see here the formula of capital RI is represented by excess return is RI minus RF, alpha is 0, then you have a beta, and then capital RM is now reflected by RM minus RF. If you just solve this, it becomes a capital asset pricing model formula. Can you see that? I'm not a Nobel Prize winner. You will not find this in any textbooks. I have derived it because that was done using a calculus. I have done it using a simple understanding. So I have moved from a security characteristics line to capital asset pricing model formula, which we use to estimate cost equity. In the process, you have seen what has happened. The implication is that the beta is calculated by security characteristic line formula, and capital asset pricing model formula comes out of this if you have two important assumptions. One, that there cannot be a return because of unsystematic risk. Anybody who's a practitioner would know that in real life, the assumptions of capital asset pricing model will not be valid. As a result of that, the one assumption that means that there cannot be any demand for a return from unsystematic risk, which an investor can expect. And the reason of that is this, a classical, neoclassical theory of economics that you are well diversified or you are fully diversified, and after that your concern is only about the macroeconomic risk. But we know that a situation is not possible, and that's how there is a separate adjustment of alpha, and this will be more for medium and small companies as compared to the large companies, because there it will be very less reflection. So the beta has a huge connection with how much I'll be loading for my company specific risk premium, which is nothing but this. And of course there are some textbooks also talks about small company risk premium, but these two things are blurred in most of the situations. I'll prefer to call it as alpha, that is additional factor coming from my own formula. And you can see that the same equation, if you can solve, the total risk could be now broken down into two components, right? This is what we were trying to solve in a systematic risk, which is nothing but the beta square and the standard deviation square of market portfolio, and then of course the standard deviation of USR. I'll show you. This will be a very handy understanding, and in most of the cases I do it and have been able to substantiate my estimate of company specific risk. Especially I can understand using standard deviation of a company which is listed, and understand how much is the unsystematic risk involved into this. And that gives me the idea that if I am an unlisted company, how much further adjustments I need to do on account of that. So this formula tells us, and you can see the R square number which we were discussing, which we have seen in the presentation when I started. R square numbers now is being shown in a mathematical formula. There it was only a layman's understanding. The sum calculation was going. So R square number, can you see, it is nothing but a systematic risk out of total risk. Total risk is nothing but how much is the total deviation from your mean, right? So R square number of 1 means that the entire beta is explaining, the entire risk is because of the macroeconomic factors. That means the beta has a high predictive power, but that's the one important indicator. This is not the final and the last. You have to understand that the standard error is the most important. Of course, you can explain this R square by the other way, that 1 minus unsystematic risk divided by total risk also. So any practitioner trying to understand beta has to also look at this R square number. Can I calculate on my own? The answer is yes. You just require a price data. It's all there available. Of course, we'll discuss about that. And then I can, through that, I can also calculate R square number, and I can also calculate standard error. The idea of estimating standard error is to know that how much my estimate can go wrong. Unfortunately, we as a practitioner believe that the capital asset pricing model is a godsend model, and what we calculate has got no error into this. There is no deviation into this. It has, starting from your beta estimation, all component, risk-free rate, equity risk premium, beta, company specific risk premium, or a small company risk premium, all is basically is an estimate. And as a result, we need to understand what is my most appropriate estimated. So I have given you the without theoretical background understanding. And after that, I explained you the numbers also. So
please let us know when we can run the poll also.
okay, so I'll tell you, because I think probably when I'll be nearing at the end, probably you can roll the poll.
Sir,
Because-
few of the participants are also having difficulty in understanding the practical implication of all the, like, okay, they are, getting your point, but then how to actually use it, we hope that, your next slides will cover the, implication
Yeah,
of.
I'm coming back to that. This is what I'm now addressing. Is that the practical? These are
Yes,
the
yes.
problems, isn't it? Before
Yes,
us,
yes.
when you go and select. If you are mechanical, you'll not understand, but if you are practical, you'll be asked those questions. Somebody will ask you a question on beta estimation, that what is your length for a look back period? So what is the look back period? You have shown it there in the calculation. Whether it should be 5 year, 2 year, 3 year, 1 year, what should be the look back period? That question will be asked, right? So when I'm looking at typically why we have gone for 5 year, the idea was that 5 year was selected to understand that one economic cycle should be covered, right? Now, one economic cycle is a general concept. It is quite possible that there could be a serious amount of a corporate action happening in a particular company, right? So sometimes you get a very, beta numbers which looks very, out of sync. That means the numbers would be such that you feel that, oh, it should not be a number, I have not seen it, I've not come across. These are the some indicator that please go and see the corporate action. So if you have not seen the corporate action during the period, corporate action could be some merger activity happening, anything significant, and some period of time the numbers are pretty volatile. If those are the situations, please eliminate them. Otherwise, your beta numbers will not be appropriate. In case if it is a 5-year period is not there, right? In that situation, of course, you can take for a shorter period, but in that the one question I would say, less than 1 year is not something which is acceptable. And the reason I explain you, and now I can go back to the formulas. I'm connecting everything. I'm going back to the formula again, because it is a covariance, and covariance is nothing but a measurement of the co-movement. I will not be in a position to understand the co-movement with a 1 year data. So how do we justify? Justification requires a longer period data. So if it is not, suppose a company which is just a listed company, so 3, 4 year, 3, 4, 5 month or 6 month or 1 year time would be very volatile period. Is all known. I answer you about whether it should be daily, weekly, monthly, quarterly, yearly, and what kind of a data set to calculate the return, then plot on x-axis and y-axis, and then calculate. That is a big selection issue, big conceptual issue. And as you said, and then I'm confirming here, you've seen this calculation. It is mostly between monthly and weekly, but some cases it can be daily also. The answer should come from your estimate of R square numbers. So you need to understand what the R square number is, how it is calculated, right? And then the standard error. This is very important. Then the next practical question is, should that be an X? Yeah.
How about in startups, sir? Look back period?
See, you're asking a question about the startup look back period. Ultimately, what is the objective? The unfortunate part is that we are going back in past. Please understand that we are going back in past or in history, to estimate beta. But don't forget that the estimation of beta, even though using past data, is an ex ante beta, right? So you're trying to predict future. So there is another concept which has now come back, which has emerged, of course, right now. Very rare professionals are using. I'm not discussing. This is called conditional beta. What is a conditional beta? What if your macroeconomic environment in which you have the data has gone completely changed? Would you still rely it? Yes, you have not applied your mind because you feel that the beta is calculated. Your question was that what should be a situation in case of a startup? Ultimately, if you are using DCF for a startup, of course, you have to prove so many other aspects that cash flow and other things are reasonably measured. This is what your standards talks about. If that be the case, then you first select a sample, right? Now, if you are selecting a sample which is a mature company, answer my question. If you are selecting a companies which are a mature company, will that be a reflective of the beta of a startup company?
No, no.
So a lot of people just do that. It's not. So what will the situation there is that you will be looking for more companies. Some of them will have only revenue. Some of them would have, maybe a EBITDA level, positive or negative. All those parameters, just see where I appreciate this point, and very important, the way we focus on estimation of multiple, the same intensity, the same level of scrutiny and analysis required for the purpose of your beta estimate also. Ideally, a group of company in a similar set of situation, that means if I'm only revenue level is appearing in my financial statement, those kind of a company of a similar could be a more comparable company to understand how behavior is happening, and I can take it. The idea is that as far as look back period is concerned, the 5-year period is uniform. If the data is available, because you are not looking at the startup data, you are looking for a similarly listed startup company. A startup company can be a listed company, a startup company can be a listed company. I'm presuming you are trying to find out the beta of an unlisted startup company. So you should look for a beta of listed startup company and try to understand their behavior. Their behavior will be totally different as compared to the behavior of other company. As far as the question of look back period is concerned, I think in that situation you have to see that what is the your the projection period. Are you going for a 3 years or a 5-year data? Because in all cases of startup, using terminal will be disaster. Would you agree with me?
Yes.
So please appreciate these fundamentals which we have developed. And now I'm going back and telling you that even the process of levering and unlevering. So today you'll get a shock. The process of levering and unlevering will have a serious ramification because that is based on a very normal and sustainable company, which is what we have no other method. We don't have any other tool, but we still have to use it. So my point is that 5-year period still remains for startup company if I get it. But if you are not using terminal, you can use it 3 years, 2 years also, but don't use 1 year. Is that okay?
Yes.
So also a concept that, if, for example, the startup is a very conceptual startup, you have an NFT or you have a virtual digital asset startup where there are no comparables available. Would you recommend that we should actually avoid the beta structure from the entire calculation of CAPM altogether?
If you are avoiding beta, which means you are minimizing the market inputs, isn't it?
Yes, so there's no market input at all. There's no effective, at the end of the day, company on the market.
So you have to
either in the developed economy or the emerging economy, for that matter.
I'm coming back to that. In that case, then you have to build it up from international market, and then you have to come back. So you are supposed to use the market level data. Otherwise, it becomes a hypothetical numbers. It's got no basis.
So what you're saying is right, sir. But the issue here is that whilst the market comparables internationally are available, they are basically fungible because they have a segment this is only a part of that, one of the segments in the entire operations. And here you have a standalone platform. So it's extremely difficult to actually have a covariance on that aspect of it. And the M factor on this will become a very difficult issue.
Yeah, I have a solution for that, but then it requires some more efforts. That solution is that you have to go for a multiple regression. You can do that. I'll show you that. It's something which is, is not routine. It requires a more understanding. And based on that, just give me a time. I'll explain it at the right point in time. I'm just parking this question. So index selection also I've discussed about that. Then you have discussed about, that's a very important part. How many companies I should select? Should it be 2, 3, 4, 5, any guess, 10? Because there is another problem now. That problem, earlier I was discussing standard error of estimate. Now I'm talking the standard error of a sample size. So if your sample size is less, right? And how it happens, more you go with a tighter definition of comparable. So tighter definition could be you're restricting to say only 5 times of your revenue, or maybe a 5 times of your turnover, of your fixed asset, if you're a capital intensive companies or EBITDA, etc. There are so many parameters. If you're restricting or a business which is absolutely close to you, that is called a pure play, your sample size will be very less. So you'll be trade-off between the sample size and the standard error of a sample. This is a different from what we discussed there. Ideally, I repeat, 8 or 9 sample is a more ideal sample. And there your standard error of the sample will be less. But if it is less than 4, say 3 or 2, your standard error of sample size, there will be 2 levels of standard error. One is the standard error of estimate, which you have seen there in the calculation. Now I'm talking about the standard error of the sample size. This could be a big trouble, and it will be a highly unreliable kind of situation. Yes, somebody can say that, yes, some situation we may not have those kind of a companies, very less level of companies. So then you have to see and your estimate of company specific risk, whether it is captured properly or whether those betas are reliable and how these numbers are getting reflected. If you are not in a position to do that, in fact, the answer for E and F are is something we need to balance it out. So if you go with start with a tighter definition, if you get the sample, say 6 or 7 or 8, I think you have reduced to a great extent the sampling, the error which can arise because of a lower number of sample size. So we have a poll questions we can answer there. But if you are not getting numbers, you need to expand. And that expansion can even include the international company selection. The moment that happens, you have to get out of this index from a local to international. Because if you are selecting companies or operating in a different economies, you can't focus on the local indices, because indices has to be similar for all beta estimation. So this is what my solution is. 5-year start is the most common period, whether you are a startup or not, that doesn't make big a difference. The point is that in case your startup is not using a terminal, in that situation, of course, you can go for a, you may not go for a 5-year because that will not be required. I think ideally you should match with the period, because most of the startup may not have the terminal, So you may have few period which is visible there. So 2 to 5 year is also acceptable. 1 year, why it is not acceptable, like given you the region. Then the corporate action, and then of course, remember that if you have a reduced sample size, then of course you are reducing the accuracy of your data. So these questions have already answered, so I'm just flipping through on that. You can use it. All these are practical, summarized, answering your day-to-day problem, especially on R-square number, standard errors are my guiding factor. I'll go back at the end of my presentation to show you this use of access return and raw beta, what we call it as if you are not using access return, you are using a raw data. In that situation, your beta can deviate significantly in some situation. And this could be the reason when you have a more impact of inflation. So therefore, one has to choose and look at those numbers before concluding. So so when you are choosing a look back period, the inflation has not greatly changed. So using excess return method versus a raw number. In raw number, we don't reduce risk-free rate. An excess return, as we know from actual return, we reduce the risk-free rate. So which type of risk-free rate I should reduce? Again, there is a concept. GSEC we should not reduce because that has a maturity risk capture there. It will be more on a treasury bill return, or in India you have a ZCYC, or internationally also zero coupon yield curve data to get this access return. I give you an idea when you are going back in the historical numbers, and if the inflation is more or less stable, then there is no need to go for an access return calculation, because even if you go, the result will not be drastically different. So this is what your summary is. Selection of kind of risk periods, selection of raw data or access return, all will have a serious implication. Forget about the frequency, monthly, daily, weekly, etc. And of course, the selection of indices. So you require to see the which one is the more reflective in a given set of situation. All these aspects I've already answered about, especially about the composition of index. You must look at least must understand before you go and estimate. I think probably we as a practitioner generally don't apply our mind, don't most of the time, because we believe that this is what I'm doing a correct process. Yes, you are doing a correct process, but you have not used your analytical part of the job. You have done a correct process of calculation, but you have not followed the analytical model. An analytical model required to understand, because unless you again, I'm going back to the formula again, unless that correlation coefficient is known, and that I will only be able to know that where my index composition is and what my company is, and this will seriously understate your risk, because the numerator part tells me standard deviation multiplied with the correlation coefficient tells me if the correlation coefficient numbers are less, and it could be because your index is dominated by something else. As a result, your beta numbers will be low, and you will be estimating a low required rate of return. As in that case, what is the solution? Because there's the formula, and is a formula which needs to be used. So if you are using that beta, explain this point and then adjust more, because those companies then will have more company specific risk premium or something called alpha. So you need to adjust for those alphas to adjust. Otherwise, you will be overvaluing the company. There's no doubt about that. So I've discussed about trade-off between sample size and accounts. Please appreciate. Start with the as I said, the tighter definition. When I say tighter definition, means a definition which includes. So ideally, my pure play company should have, say, 70-75% of the revenue, similar to what I do. If it is not there, then I can go for 50%, 60%, and 10 times I can start, then can go for 15 times, 20 times, 25 times, 30 times. Even if I'm not getting, then I can move to the international. So idea is that maximize the inputs available in the market, the way a rational investor should have done in a situation, rather than closing eyes, blinding it, and saying that no information available, and therefore I'm doing based on hanky-panky thing. I think anything which you do, which has no basis or something, there is no observable input into this, you are risking yourself. It's very difficult to justify. But if you say that because of this limitation, this is what is available, and out of this I have concluded like this, that makes more sense. And everybody understand that it is an estimate. So the estimate has to have some basis. You can't go and simply do it. I mean, I don't mind even somebody was asking me, what if if the beta is absolutely, I'm not getting anywhere. So you can then you have a build-up model. You can develop. You can take an industry beta. If that also is not possible, then you can start from a modeling based on your cost of debt. It's possible. But then you have to see and reconcile it and give a substantive reason that why you are debating from something which is a settled, accepted practices. It can't be a, the first step. It has to be the last step. So you start from that, give a justification, and then start building up of your cost equity. But having said that, I am with you, and I agree with you that in a situation where we don't find the data, right, rather than using something very mechanical, which I can't explain, which I can't defend, which I don't understand, it's better to do something else. And there are other methods, and some point of time, maybe I'll come and explain you when those situations are not there. There are solutions for that. We can do that. So all this I've already explained. These are the types of betas which will be, I'm just explaining that one more interesting sort of beta is all we know about OLS beta, that is your ordinary least square method, or regression beta, or top-down approach, raw beta, all these names are similar. And then today I'm discussing something widely used formula, how conceptually wrong is. So unless you go back into the theory, you'll not be able to understand. I'll discuss about that. We are using Hamada equation, but have you seen the assumption of Hamada equation? And once you see the assumption and then you do what, we'll understand the implication of that. Of course, there is a, we assume the beta rate is equal to 0. We assume the preference says that beta is 0. We assume that all equity equivalent, like warrants, like options, their beta also equal to 0 while calculating cost equity, isn't it? And therefore, there is an implication. So the new model, the new development requires all those understanding. It's not so simple. So that is why the valuation standards of IVS has now come up with a complex capital structure valuation versus a simple capital structure valuation. What unfortunately, excuse me for saying so, that's the reality is, what unfortunately we are doing is that even in case of a complex capital structure, we are doing as if it is a simple capital structure, including your insolvency cases, and without even understanding that the formula requires what. So you need to understand the theoretical background. So I'm sorry. I mean, I don't move unless people are very comfortable with the formula, because if you don't know what you are doing, what formula, how formula has been derived, so the result and outputs will be highly unreliable. How will you defend it, boss? You need to know. You're a valuer. What you are saying is that doctor should only know that this is a disease and this is the medicine, without understanding how this medicine has been, developed, how it is going to affect my body. All aspects has to be understood. Otherwise, you will not. You should be like an internal medicine doctor. Anything that is prescribed, you must know the overall implication in the entire body. Cash flow, discount rate, every element. So,
Sir, excuse me.
Sorry.
Sir, in your case, you mentioned, can you throw some light on this bottom-up beta and how we need to calculate, sir?
Yes, I'll do that. So this is what I'm just showing you through, and this is what your first, let's say start with the sum beta. Why it is important? I'll show you this one of the litigation cases, and one of the recent in the valuation world, Sanan Pratt, when he was cross-examined, because I'm getting cross-examined across the globe, so I have an idea. I'll share with you what he talked about the sum beta and how it is reported in the report. See, the raw beta or OLS beta or regression beta, which we generally calculate. I mean, don't get offset with that this terminology is something which I'm not comfortable with. This is something very routine. So the idea is that for medium level companies and a small company, which all of you would agree, especially in a country like India, and if you are using a index like Nifty or maybe you are using index like say Sensex, which is dominated by few stocks. So what will happen is that because the large companies are met or are monitored by large number of brokerage houses, and therefore whatever happens to the economy, that information is, I'm just giving a theoretical background so that you can understand. So because they are being monitored, they are being discussed, they calculate those implications quickly and then pass on to the market, and then gets converted into the price. So what happens? Same period calculation. That means if there is a change in Sensex, that's what some I think initially it is started, that beta is nothing. If it is 1, then 10% there, 10% change. This is the theory, right? It should, but practice is that something, especially for the moderate level companies or medium level companies, small companies, this will not find. Why? There is a lag effect. Why there is a lag effect? Because of there is another phenomenon. There will be very few people who will be monitoring your stock, so people don't understand the implications, right? And they would be behaving more like a say unlisted company, and their stock would be having a lag effect. So if something happens in the economy, those that means if it is reflected in the indices, the impact on those sales prices will be having a lag effect. So therefore, there is a another concept called sum beta, and sum beta is basically a multiple regression. So this calculates one component of beta the way we do in case of OLS beta, and the other component with a lag effect of 1 month or 1 week, whichever methodology you do it, and then calculate the beta. The sum beta is a more appropriate beta because of a phenomenon in stat called autocorrelation, right? So these aspects are very important. It has a huge implication on your beta calculation. I'll show you this reason I already explained, so you just have to read it. The sum beta is a concept which is used for a small or medium company, which we do most of the time. Large companies, gets affected, and therefore, if it is a same time Nifty, the sum beta addresses the problem. And look at that, how it is calculated. It has a 2 component. The one same formula. Can you see it? This again is a y is equal to a plus bx, but now there is a 2 component within this, right? One with a 1 month or 1 period below. So this is t and this is t minus 1. So it is weekly if you are calculating, or a monthly. So you have to go back and calculate a sum beta. This would be a very, very appropriate calculation. And this I have taken from Sun and Pratt explanation. Look at that, the way international codes expects you to perform and present your situation. Why we have chosen OLS beta? Why we have not chosen sum beta, right? If you have chosen sum beta, what is the reason for that? And that's the reason he is given. And he say, I did not rely on OLS because OLS approach tends to understate the true beta of a company that exhibit cross autocorrelation with the market portfolio. A cross autocorrelation is nothing but a situation where a small or medium company has a lag effect. That means something happens to the a particular stock which is forming part of your index, and these companies come later on because people impact, the people visibility will be less. And this is kind of an explanation goes. In India, oh my God, here some of the valuation report have come across where people even assume beta. What they write, I have not found any company and therefore beta is equal to 1. So this is also a valuation report, isn't it? This is also a calculation of cost. So you're saying that since I have not found anything, therefore the beta should be equal to 1. That means you are presuming that these companies almost have the same characteristics, which is a market portfolio characteristics. This is the same explanation for you, and that's how it is reported in the report. So I thought, let me discuss about that. Sum beta is a very effective tool, especially if in a sector, for instance, as I said, in a situation where you are not able to get a appropriate correlation or immediate impact on our stock prices, when and you can always check this stock price of a company versus index, what kind of a correlation is there. So it will tell you whether you require a sum beta calculation or not. It's not something very different, but yes, it is a very important concept. So now I'm coming back to another set of beta that is called a 2 set of adjusted beta. One is called Bloom adjustment, used by Bloomberg, right? Here it is a very mechanical formula. So you calculate a raw beta. You have seen raw beta calculation is a raw data of index return versus raw return of a stock, and then 2/3 you multiply and 1/3 multiply with 1. Why do we multiply 1/3 with the 1? Because we believe that the 1 is the market portfolio beta, and give a weight to 2/3. So the idea is that over a long period of time, every stock beta will get aligned towards 1. So this is a one size fit all adjustment. I never use that. Excuse me for that. The reason is that this is mechanical, and somebody say, oh my God, I've used Bloomberg data. Yeah, you have used that, but please explain me, have you checked the standard error? This formula is irrespective of standard error. What is the importance of standard error in beta calculation? Because this tells you that how far you are there from this regression line, vertical distance from up or down, right? So if it is high, how can that be 1/3 and 2/3? So you will get your theory will be vanished in no time. So this does not capture this aspect at all. So this is, I'm not saying it can't be used at all. Some situation you might require it, but where you are using, you have to be ready to defend it, right? But as a practitioner, this is there, and some equity research analyst or venture capitalist or somebody else, because they are more relied on some data. And if you're there using Bloomberg, I'll be not surprised. But as a professional, can you use that? That is a big question. Now, somebody is saying that the startups are unique idea. Okay. So how do we get a comparable? Okay. A startup could be unique area, but what about the business? If your uniqueness is because of your business model, because of your margins, because of something else, I have a solution for that. But that must be falling under some industry, isn't it? Don't go with the uniqueness. Everything, every company by that way is unique, isn't it? Every individual is unique. So therefore, there will be no calculation. It's not the concept. Macroeconomic study is, even if you're unique, your unique could be like, you can say, if I ask you a question, which is, of course, take example of a Flipkart, take example of Amazon, take example of a Alibaba. Are they online platform? They are they comparable? I mean, when you come to the comparability, there'll be a huge difference. I get your point. Like Alibaba is in a complete protection by the Chinese government. Regulatory protection is available, not available to Flipkart here. Amazon is not only an online platform. So what we have to understand is that you're still falling into the online platform business. That's the broader. So I'm moving from my tighter definition to a broader definition to create an overall sample so that I can understand the macroeconomic behavior, right? So now go back to.
Can I, if
Yeah,
I can
please.
interrupt,
Please.
can we, if they are falling under, say, two different industries, for example, these days we see some tech companies, like, for example, Zomato, before getting listed, we can, I mean, it is a delivery business. Business wise, it has some other purpose, but basically we can also call it as a tech company or an online software led industry. So is it okay to take probably a weighted average or an average of two different industries? And
no, I'm coming. It's a very nice question. I'm coming back to your mind. I'll first start with what the Zomato does it and where it is getting risk into this. What is a business is? It's a restaurant business, isn't it? In a delivery in the restaurant segment, So the way the restaurant business are going to do well, and if you can go back, I'm not exaggerating what I've said. Last year, I made this prediction. There were 12,000 people hooked to the institute program, with a technical analyst. And I said so then that if you understand the Indian market and the restaurant segment, because why I'm saying, because when I did a valuation for, now I can tell you the name because I'm out of this NDA, McDonald. You must have heard about that McDonald case, Mr. Bakshi case in London Court of International Arbitration. And at that point in time, I did a research across the globe of restaurant business, including McDonald's. Can you believe the two Englishmen arbitrator and one, of course, Indian, with a dissenting vote, the valuation done was minus 60 crore. To my surprise, you just imagine as a valuer, somebody doing a minus 60 crore valuation, and the judge is also passing a judgment. So I turned it around, At that point in time, I realized, so what was my prediction last year? That the way Indian people, if you understand the psyche and the market here, if the moment the corona impact will go, then people will start moving. Will they still buy sitting at their home, and will they love to go to the restaurant? Any idea?
It will be a combination of both.
But it will not be the one what was happening in the.
They will love to go to restaurants, but the increase in home ordering will see a distinct shift. I mean,
Yes,
home ordering will be more than pre-corona level. So there will be a
very nice. You
increase
said
in
so. You said so, sir. So therefore, what I'm saying, it has a risk attached with where? As a tech platform, or it has a risk attached with the restaurant business. The more restaurant works, the less would be the Zomato impact. Of course, the people are also now, Zomato has now diversified much more than what it started with. Because I'm also, I can't tell you because there is a NDA requirement. Somehow I was also involved in Zomato valuation. So it has got 50 plus subsidiary. But anyway, I'm just telling you that when you are looking at this, you start with a company in the restaurant segment. Of course, it is more on the online and taking order, but the risk is flowing from there. If you don't get it, then of course, then you can increase the sample size. But realize that the margin which Zomato will earn will be affected with the overall margin of a restaurant business. Would you agree with this?
Yes.
Yeah.
So therefore, you will be more affected the way the restaurant business works. If it is a 15-20% margin, and that's within that only you can make it. Otherwise, other people will not make money. Of course, their model was to something else, and some point in time you can survive for some, but for a longer term to become a sustainable, you have to do something else. So what I'm saying, don't just get carried away with the classification done there. You should try to understand the business and the business model and the industry which it involves and how it is going to affect on macroeconomic numbers. So and another economic environment. That is how you will select. So you've seen in my calculation what I showed there. There was a adjusted beta. This is called Wazichek shrinkage or Wazichek formula. This is much better formula. This is you can calculate. I've given you the formula below. It's simpler, or you can use it capital IQ if you have a subscription. Though these are very costly subscription. Unfortunately, in India, nobody provides a full basis calculation of beta or multiple, which is available in US and somewhere else. Of course, this could be another area of a business, depending upon how we will survive. But here you can see this is based on VA is basically the variance and the beta of the market and the variance and the beta of individual security. So this is more appropriate and this is a more scientific basis as compared to your Bloom adjustment. So Wazichek, always you will see this beta will be lower, more or less. Very few situations will be different. Here we are trying to find out, and I use this where I am not getting a very comfortable guidelines and then and very varying numbers of beta, or I have to use a very expanded definition, not a restricted definition or closed definition. So I'll use this because that gives me overall idea about how this company takes in as compared to the market. So this is what your two set of adjusted beta. Two database agency provide separately. The one provided by the Bloomberg, other provided by the Capital IQ. This you can always calculate. It's not a very deeper mathematics involved into this. Especially the Wazichek adjusted beta is more reliable. It's not a one-size-fit formula. And of course, when we are capturing here the market of that particular industry. So it could be a 10 company, 15 companies, and then within that, the one which we are looking at of individual securities. So that will be much better, you know. As, even if you're a listed, I repeat, sometimes your own beta will not be that much reliable. So that was the one. Now you are asking me the bottom-up beta calculation or a full information beta calculation. All calculation, if you want, I can share to the Excel sheet in a simplified version. This is a which I was discussing multiple regression. So what it does is that ideally for a normal proxy beta calculation, which I'll show you later, you try to, and that's what we have been taught. We understand this is a correct picture. We try to find out the comparable companies or guideline companies. You start with the pure play companies and calculate. But what if you don't get each company will have a different composition? You know, I'll take you one example and try to understand that. Take Godrej. There's some background noise, so you have to mute yourself unless you have a question and you want to ask me, right? So what I'm saying, take example of a Godrej. There's a set-light business model for real estate in India. It's a unique company, you know, in a sense, but it still is a real estate company. How does uniqueness is reflected? A lower margin, but a lower risk. Why lower risk? Because they don't have their own land. They take somebody else's land. And then they participate. That model are different. You can't compare with the DLF when they have their own land, but still they're in the real estate company. So the business model will have impact on your operating margin, isn't it? If you're within the same segment. So if you have a more large number of such companies, this gives you a better idea where should we go. What we are looking at here in this full information beta, that when we don't get a very pure play company or even expanded definition does not give me adequate number of sample size, which would result in a high level of sampling errors. To address that, I'll go for a full information beta or bottom beta, and that here I'll be able to find out a company. But only one point here. To use this concept, you have to have a segment reporting. I'm presuming that, unfortunately, in India, I've seen some companies where there should be a segment, they don't give any segment. I don't know. I mean, this could be an auditor's issue. I'm not saying if you don't have a segment in the financial statement, you can't use this model. So you have to have a segment data, and based on that segment data, you can use a multiple regression and then get a appropriate beta. So this is called as a bottom beta, to be used in a concept, to be used in a situation where you are not able to identify pure play company. So don't throw your hand. Oh my God, I have not got a comparable company, so beta cannot be estimated. So to give an example, you might find a situation where a cement company have some got financial company component within that, right? So if I don't get a pure play, I start with that and then catch it and then get a multiple regulation to get that beta of a finance company or of a cement company. It is a possibility. So this is what is a bottom-up approach or a full information beta estimate is. You require a segment data and run a multiple regression to get your desired beta. So, but if you try to do so based on 1 or 2, 3 company, I think that would be highly unreliable. It requires more last sample because now it's gone. So what are we trying to find out? Read more balance sheet, read more annual report, try to see the segment. If the segment tallies with you, run a multiple regression and try to find the beta of that segment. This is a possibility. This is what is a full information beta. Now, this is a very important part. Will also help you. Now there is a model which is being extensively used. In fact, I have been using it, Butler-Pinkerton model. That will be for your estimation of a quantitative model for estimation of your company specific risk. In fact, somebody is asking me, I'm very uncomfortable for a company, especially in case of a startup, rather than going for a beta, why can't we go for a total beta? Now, Silpa, this again comes from the same formula. So unfortunately, I have to go back to the formula, to the beta formula. Just do a small tweaking. You've seen the beta formula. What was in the numerator? Standard deviation into the correlation divided by the sigma m, right? Just do a small tweaking. So beta I, you divide with the correlation coefficient of I with m. So that becomes my the left hand side. So what will be left out on the right hand side? The sigma I divided by sigma m. Are you getting my point? So it is a total risk divided by of a security divided by total risk of a market portfolio. Same capping formula can be used. This was invented long back. In fact, Damodaran also discussed in somewhere in 90s. Now Butler Pinkerton has come up. You will be more comfortable in case of a startup companies to not to use this total beta concept to calculate your cost equity rather than using a standard capital asset pricing model, because your situation would be that totally different. So in this model, this formula is a tweaking. I repeat, this formula is a tweaking. Don't look at the left hand side. In fact, this is what the second equal to is a left hand side formula, which is nothing but I've just trimmed that correlation coefficient of a security with market portfolio as a denominator to the beta. So right hand side only remains the total risk. So I'll read like this: total risk of a security, right, divided by, technically can call it as a total risk of market portfolio, but principally I know the total risk of a market portfolio is nothing but is a unsystematic risk, a systematic risk only. So therefore it is a relative measure and it can go back into the same formula. Instead of beta, you can use a total beta, and you can then you don't require any other adjustments. Is more appropriate for even for listed companies which have got a very few, as I said, transactions happening, infrequent transaction happening, and something which is your prices are not orderly, or for an unlisted company or for a startup company, it could be a nicety. Also, now coming back to your debt beta, same formula, you can use a small adjustments for taxes, 1 minus tax, same regression line you can use. This can also be used for the purpose of calculation of beta debt, So if you have a listed debt parallel to you, you can estimate from there. If it is an unlisted debt, that most of the cases in India would be the situation. So what you do is you have you can presume that whatever the pricing done by the bank is reflective of the market situation, and based on that you have a number of return data available over a period versus, of course, the Sensex data. From there you can use a regression line and calculate beta D. That will be very handy. I'll tell you when we go for a calculation, especially for. Is there any question? So now one important aspects at this stage, because these are something which you are very much aware, so I'm not focusing more on this. What is more important for us to know at this stage is that when we are re-levering or unlevering, what formula is appropriate. So I'll take 5 minutes there, and thereafter I'll throw the session open for you to ask questions more. So two important aspects, two conceptual points. Which formula is more appropriate? We'll examine that. Of course, I'm not focusing on formula because this is not a session where I can explain you the formula. But of course, I'll tell you the conceptual point of that and what you do exactly and how you go in a wrong side of that. So two important points is that before unlevering, because ultimately, suppose I have to find out the proxy beta, I may need to find out the weighted average or simple average of beta assets of various companies. So whether I do it on leveraging on individual basis, or we first get an average of levered beta and thereafter do on leveraging and also make adjustment for the cash, excess cash, because excess cash also has an implication. So conceptually, you should do unlevering, after first getting average. Because if you're not doing, so there'll be a huge amount of noises. Noises in the beta would be a higher standard error. A higher standard error, if you do on leveraging on individual basis, it is going to create a trouble for you. So this is it's a very important point as far as what stage I should do a unlevering portion. So I explain about that. Now, everything written here, what I've talked about, also focus on the tax rate which you are using. At the stage of unlevering, it should be a marginal tax rate, because this is what you generally do in your cash flow mechanism. I'm presuming here that you are not using a effective tax rate and thereafter making a separate adjustment for your deferred tax assets and deferred tax liability, etc. So the way the cash flow is designed, appropriate is to use a marginal tax rate, otherwise your beta calculation will go wrong. So if using a historical effective tax rate as is being done in capital IQ will lead to a very difficult situation, right? And you can see, be careful about the noisy calculation of beta. Noisy beta is one which has got a high standard error, will have implications. The important point about the last 10 minutes, I'll focus here. Just take your time. Levering and unlevering, basically, you can address the financial risk. I'll also tell you today how to address the operational risk. We have not understood two companies having two different level of fixed cost. Will they have the separate different operating risk? Answer is yes. Unlevering and levering will only impact your financial risk part. Is there any formula for do that? Can we do that? In my estimation, answer is yes. So let's first look at the very famous finance formula, and I'm sure you must have been using this in number of assignments. But have you ever thought that how this formula has been derived? I'm not going to derive, at this stage, but I'm just going to explain you the implications of the problem. If I tell you that this formula of levering and unlevering, both we are using beta asset is equal to beta A divided by 1 plus D, 1 minus tax, debt by equity. You can always say that beta asset is a discounted value of beta equity, or beta equity is a compounded value of beta asset, and the compound or discount is on 1 plus something. That something is debt by equity, 1 minus tax. Now the problem is, when you do this and you freeze debt equity with some, say 60-40, whatever, the moment you are doing, you are saying that the proportion of debt and equity, the proportion of debt equity will remain constant right from today till infinity, which is what this formula does not say. The formula is based on the fixed amount of debt. A fixed amount of debt is different from fixed debt equity ratio. A fixed amount of debt will keep on changing my debt equity ratio every year. So you require a variable discount rate to address that. This is what people do not understand. This is a very serious implication, right? So this formula will malfunction, and in most of the cases it will, because this formula presumes equal amount of debt, no change in the debt right from today till infinity, whereas we are presuming that the debt equity ratio is constant, and this formula is not fit there. Then there is another problem. Tax saving on interest, this formula presume should have the discount rate of cost of debt. That means both should have the same level of risk. This may not be possible risk in case you are a stressed company, in case you are having a higher debt or more operational risk. So because if you go into this, this is what the formula requirement is, and we do something else, so there is improvement in the formula. Miles-Isel formula. This formula is basically, I'm not discussing here the formula portion, but if you go back to this, this is what you do. This formula presumes debt equity ratio constant. First question is that should that debt equity ratio should be constant always in the valuation of DCF? The answer is no. Most of the cases you require a variable discount rate. I can tell you this I've used in case of McDonald's. And I confronted them because if you use a constant debt equity ratio, it inherently captures the tax saving or interest, right? Whereas your projection has, you can say most of the projections, your debt component has either reduced or some of the cases can go down. As a result, what will happen? Your value will be overstated by using a debt equity constant ratio. But if you're using a debt equity constant ratio, which is different from keeping debt constant, right? Then it should be a Miles result formula rather than a Hamza equation, which we generally use. I'm not saying that why people are not using, I have no explanation for that, because they don't apply their mind, they don't look at those assumptions they are using because others are using, and it is written in the textbooks. But look at the assumptions. Look at the assumptions. This requires a beta debt calculation. You can always calculate. That formula also requires a beta debt calculation. Unfortunately, it is not there because in the formula, beta debt is presumed to be 0. Beta for a preference share presumed to be 0. Beta for your other element is also presumed to be 0. So, especially for a company, Amazon, which has a very low operating cash flow, so there will be a default on in terms of your or likely situation, and it will have a beta debt. Typically, beta debt is positive, varies from 0 to 0.10. That's the general range of this. This is a very handy formula. A similar formula is a Harris-Springer formula. Again, this is for a similar situation, a little bit change as compared to that. Here also, market value of debt equity ratio remains constant. When you are using, so you have a two choice, either Miles formula or ME formula or HB formula, Harris-Springer formula, where you are keeping market value of debt equity ratio constant. In a Fernandez formula, the book value debt is proportionate to the equity book value, and of course it increases in proportion. But this is a very least used formula in practice, so I'm not recommending. But as a conceptually, this also has a very sound foundation. Now, this is the summary of this, that if I have to use a constant book value debt equity ratio, Fernandez formula, some of the cases, if you are not able to assess the market value or book value, you can always use the Fernandez formula. But if you are most of the cases, you would be required to use the market value. ME and SP formula is very important if you are using a constant. If you are using a variable discount rate, then of course you can go for a Hamza equation. There is no doubt about that. Then you do a adjustment for a cash. This would be before you go for a re-leveraging exercise, and that is adjustment for excess cash. Like you can see in my samples, a few companies have a huge pile of cash in their financial statement as compared to the other real estate companies. So you need adjustments, otherwise the cash element will have a lower risk and then beta calculation will go wrong. This is a formula can be used in a Harris-Springer formula, as I was talking, to make adjustment for operating leverage. Okay, so look at the kind of analysis required. Here you can calculate beta of operating assets by taking impact of fixed cost and variable cost, and that's the formula for similar formula for making adjustments of differences in fixed cost versus variable cost. Because whatever formula we have seen so far, none of them are making any adjustment for differences in operating leverage, and it has again its implications on my formula. Harris-Springer formula allows you to do that. Becomes requires more efforts and for implement this, but then there is a process, there is a implication. So on my side, I've covered this. If you have any questions, I can take up. Is anything you want to ask on this?
Yeah, while the participants can raise the questions, I have already launched the first poll question. I request all the participants that this being a CP creditor program, IBBI will be shared the poll report. So request everyone to please answer the poll question.
So, Mr. Rajiv, good morning.
Yes. Good morning.
First of all, fantastic. This is a great presentation, and we really liked it. And obviously, one more time we need to go through it. Question is essentially on the cash flow projections, because here we focused on beta because that was the topic. But you talked about inflation. The cash flows also that you project has an inflation component. And in the numerator, if we are looking at the inflation component in the cash flows, here in the denominator, you are saying that inflation has to be adjusted.
I just missed a few words because your voice was not, I couldn't hear you. Can you just repeat again?
Can you hear me now?
Yeah, I can.
Yeah, two things. When you said beta has to be looked at it also from the inflation perspective, because year on year there's an inflation that changes on day zero when you're looking at it. That need not be the same inflation later on. Is that a correct statement? Did I understand correctly as regards that?
No, what I said is that to decide whether you want to use a raw data to calculate beta or you want to use a access return data, you have to look at the changes in the inflation. If the inflation changes are higher, a raw beta will not give you the appropriate set of data. So we are still in history, sir. I agree with you. In projections, we definitely capture the inflation and we presume that this kind of a situation will prevail. Otherwise, we have another concept called conditional beta where we change for a macroeconomic factor. I'm still in past. I'm just trying to address that in the past since say 5-year period. Suppose 2-3 years it was around 15% inflation and the last 2 years it is just 5%, isn't it? In that case, the access return basis calculation of beta will be more appropriate as compared to the raw data. I hope it is clarified.
Okay. So, see, the betas, what we are calculating is essentially for estimating the future cost of capital.
Absolutely right. So I have removed the, in fact, to give you a very layman sense, I have normalized the impact of inflation by calculating access return to focus more on macroeconomic risk in the past, right?
So do you also recommend that going forward year on year, adjust the discounting rate year on year? Because every year there's an inflation.
Yes. Yeah, I think you do so when you have a variable capital structure. Discount rate, variable discount rate is more appropriate. Using a constant debt equity ratio will give you overstated value.
Are we not using FCFF for that? Because the capital structure impact gets nullified if you are using FCFF.
No. Cash flow when you are projecting, and after that, because your capital structure are varying, if you use a variable discount rate, invariably you will be using the right discount rate and your value will be lower as compared to a constant debt equity ratio. Because in a constant debt equity ratio, you count extra tax advantage or interest. To give you a reason for that, suppose I start with a 100 crore debt, and over a period, if the debt is getting reduced, and my estimate at time zero is on 100 crore debt. So from today till infinity, I'm counting extra interest on that. Are you getting my point? If you want to get out of this altogether, there's another model called APV model. Especially you are using in LBOs or high debt companies or maybe our IBC kind of valuation.
Okay. So you're saying even at FCFF level, you're saying since you're using 1 minus the tax impact, the tax advantage you're taking.
But then in FCFF, you're taking you're not counting in the tax advantage on interest into the FCFF. Am I right? You're counting the tax advantage on interest through the discount rate. Am I right? So through the discount rate, you are presuming that the same level of debt will prevail from till infinity, which is not the reality.
Mm-hmm.
As a result, you are counting extra value.
Okay.
So I had a question on when we do not have comparable companies, we cannot find appropriate companies in India, but we can find some in other markets. If we actually compute based on that other market, would that be right to apply on, because the entire operations of the company is, say, in India, would it actually be appropriate to take a bit of computation from foreign markets and apply it on cash flows that is being earned in India?
Okay, fine. So what I'm saying is that in that situation, when your operation is restricted, but you are not finding the international market data will still give you a proxy beta, isn't it? And in a macroeconomic, if your macroeconomic behavior, or that you can find out that index behavior versus your index behavior can always be calculated based on correlation, you can make an adjustment into this. It is possible. Or you can adjust to the company specific risk premium.
Sir, I have a question. Total beta, if you're using total beta, then we don't need to add alpha?
No, in that case, everything is captured. You don't need to add alpha.
So total beta is usually greater than the normal beta, is it like
Yes.
beta?
Yeah, because you can see it is in the formula, it is a standard deviation of the security divided by the standard deviation of market portfolio.
Since there is an extensive discussion on startups beta, so one of the ways.
Sorry.
Okay. See, one of the ways is startups. The moment if you were to look at a comparable non-startup entity, as you said rightly, the business way of looking at it, size of the companies and other parameters, estimate the beta of that entity. And when we say that this should be the beta if this company were to be listed. And then what you say is the excess return, what you kept referring to as excess return. Now, because it is not listed, and B, because it is having still uncertainties of the rightful things going right, you put that excess return, that is that alpha. That excess return, how much it could be, it is because of the illiquidity, it is because of the
Hold. This is a very serious error people are making. Never make any adjustments on account of illiquidity in your discount rate. This is disaster. Never do that. Never make any adjustments on account of illiquidity through the discount rate. This is not appropriate. There are various valid reasons for doing so. One is that the illiquidity, when you talk about it, it is for a particular period. Once you are loading, you are presuming that it runs from today till infinity. That's not correct. That's the reason why it is addressed through something called discount for lack of marketability as a certain percentage, not through the discount rate. Why alpha adjustment is required? Three basic reasons. One, first important is that if your cash flow projections are not scenario based, you agree with my observation? If it is a one set scenario, most of the time it happens in practice, you effectively have not addressed the projection risk into your cash flow. So therefore you require an adjustment separate. The second is a theoretical idea. The capital asset pricing model, or CAPM, presumes that investor is well diversified. For an unlisted company, it is very difficult to assume that investor is well diversified, and therefore investor would ask for an extra demand for that. There's another important concept which we need to consider at the time of focusing on that. And then, of course, your company, unlisted company, can have an absolutely different, unique risk, which will be different from what is there available in the market. Like I am having a huge element of debt. If I am a say lending company, my operational procedures are very bad. When you do analysis, all those are indicators that you require a alpha adjustments. Of course, Butler-Pinkerton is the one model where we first calculate total beta. I can tell you one quantitative model to do that. Total beta minus beta into equity risk premium will tell you what is the listed company extra return for a unique risk. or what we call it unsystematic risk. And from there, you can take an idea that if this is my company, what additional I will take. So I repeat, how do you calculate? You take a total beta minus beta, that's a normal beta, OLS beta, multiply with the equity risk premium. That becomes a excess compensation in case of a listed company. We ignore this there because we believe that the investor is well diversified and the cash flow projections are. But if you have done a scenario analysis in your cash flow, that means a multiple scenario cash flow, then you should not load alpha because then it will become a double counting.
Sir, one question I had. This slide that you're showing up right now, in the adjustment for operating leverage, right? We are writing that, typical formulas will only adjust for leverages financial risk only. So are you suggesting that this formula has got to be used over and above the formula for financial risk?
When you are using Harris-Pringle formula, at that point of time, if you find that the comparable company and your company's operating leverage is drastically different, for various reasons, because of the operational issues, then you should use this formula.
No, but the question is,
after that calculation, this you can use the.
That's what. So you're saying that both has got to be used, right?
Yes.
First you have to adjust for the normal formula where we only adjust for financial risk, and then if we see that the operating leverages are different, on top of that we use this one, correct?
Yeah, you got it, sir. I think this is why I've said that you are all levering on levering formula only address for the financial risk, and you presume that operational risk are almost similar. I mean, that's the concept.
Would the sequence matter? I mean, or can you do any sequence, adjust for total leverage first and then adjust for operating leverage, or how does it? Doesn't make any difference.
We are so mechanical. We are not interpreting and understanding why we are doing so. So it goes in and becomes a practice. So many people does the same thing. It becomes a practice. You see the large number of textbooks, they have only discussed Hamla equation. They have not discussed any other equation for levering or levering. Good for academic purpose, but for a practitioner, it makes a huge difference. If I notice this.
Okay.
So regarding your answer to that, the beta has to be the different, debt equity has to be we used different for different years, and FCFF does not give effect to the different debt level of the different years. But I guess in FCFF you use the earning before interest and after taxes, right?
Very nice.
Then does not give effect to the tax shield of the interest of that particular year's debt level.
Very nice. I'm coming back to your point. So what FCFF does it, sir? It does not count the impact of tax saving on interest through the cash flow in FCFF. You agree? It counts that impact through the discount rate. And how it counts? By taking after tax cost of debt, right? So what will happen? If you have a high element of or huge element of debt, effectively you are counting higher amount of, and how it counts in a very simple, to take a perpetuity formula, if D is the amount of debt, suppose an I is the interest rate and T is the tax rate. So if you have 100 rupees of a debt, 10 rupees tax savings. So 3 rupees right from today to infinity presume, and then discount it as the same 10%, assuming coupon rate or market rate same, is your value of advance. Now the problem happens is with this, that suppose making company.
Are you all able to hear the speaker?
Pierce, there's some disturbance. The voice is dropping.
Maybe, yeah.
Discount rate. In case of FCFE, it counted through the cash flow.
So we are not able to hear you intermittently, Rajiv sir.
Switch off his video.
Separately counted.
Rajiv sir,
Yeah.
there was some internet connectivity issue from your end. Looks like we were not, we couldn't hear you intermittently. So maybe you can switch off your video and go ahead.
Okay, so let me switch me off. Am I audible?
Yeah, much better, sir.
Okay.
Intermittently, we couldn't hear you.
Okay, fine. So what I'm saying.
Again, we have lost him.
Yeah, the audio is gone.
What he's saying is, in the weighted average cost of capital, the weights are constant for debt and equity, but over a period of time.
Can't hear, please.
No, the speaker is not able to. Yeah, speaker, I think exited. Yeah, he will be joining. And I really want to apologize for everyone. I had to rush the poll questions because I was getting continuous requests. I understand we had to understand the question better from the speaker, and then I had to give an opportunity to all of you to attend. But then continuously people were requesting me to launch the poll questions. I really apologize for that.
Shilpa, we will need the recording of this session. We want to hear it.
I understand. Even I am on the same page when everyone is putting on the group, and here I understand, so
Yeah.
for sure, I'll get back to you on this for sure.
I think while he's not there, I think this is the question. I think what he was referring to, basically what I understood is the weights of the debt and equity, we are assuming it as constant in the FCFF and the discount rate. And he's saying that since that is not constant, and if your initial debt and equity is higher, then the tax shield that you're considering the discount rate, you're taking a higher benefit.
Yeah, that's the one error which we do. Other one we do through the using Hamza equation, because the Hamza equation presumes that the debt amount should be constant, not debt equity ratio should be constant. That's another problem.
And you also said that liquidity we should not adjust in the discount rate, we should adjust in the value.
Liquidity should always be adjusted through what we call after due evaluation, called discount for lack of marketability, right?
Yeah.
Don't do adjustment there through the discount rate.
Yeah. So therefore, the other way
is not actually. Then I have to rush because as her brother got accident. What happened?
I don't know. Accident happened.
Rajiv sir, presently you're on mute.
She has not come.
Yeah.
That's why I also have to rush. I came at around only 9:25.
This is a crosstalk.
Can we mute him, Mr. Saurabh?
Yeah, Mr. Rajiv, regarding again the startup part of it, going back, see, the challenge is just to apply beta, as you rightly said, it's a mechanical way of doing it, and there are serious challenges. And are you just to tend to assume 30%, 40% irrespective without really looking at the rationale? So if you were to use this fundamentals, what you stated, predict the beta, what would be for a regular, a similar kind of entity for a listed security, and to that, if you want to add an excess return of the uncertainty, I'm not using the word illiquidity, the uncertainty of the current setup. If one were to use that method, that excess return we want to add to this calculated return, which is essentially nothing but the company specific risk. Any suggestions there? How do we get that EI that you are referring to?
Yeah. So the one way, if I discuss with you the quantitative model, one of the quantitative model is known as Butler-Pinkerton model. Their total beta you take and you reduce the OLS beta in bracket, multiply with the equity risk premium. That gives you an idea about what is the required excess return for a listed company. From there, you compare and see whether if you have 4 or 5 companies return for unsystematic risk available, out of this, based on your comparable, if your subject company, you will be able to derive what should be the excess return as. That's the better way of it.
And then you add the multiply with that illiquidity.
No. My illiquidity should be the last. Once you've done the valuation, then go for a discount by lack of marketability.
On the value. Okay.
On the value. Never do it through the discount. I can give you multiple reasons for doing so. Is incorrect.
Correct.
Some textbooks writer, let me tell you, have mentioned that, including Damodar. That's not a conceptually correct one.
Thank you.
So while using levered or unlevered beta, can we use target debt equity ratio?
Sorry?
While calculating levered beta from unlevered beta, can we use target debt equity ratio instead of calculating multiple discount rates?
I'm coming back to that. Before you use a target debt equity ratio, first you have to see that is that appropriate to a given set of situations. For instance, if you're doing for a say startup or a very small company, is there any scope that company can even go close to the target debt equity ratio based on the industry sample available before you? If that not be the case, never do that, because that will be inappropriate, right? So you have to then develop your debt equity ratio by using an iterative model to go to what is called a market value basis. So target debt equity ratio, especially for a minority share valuation, is not the right way of doing
it. Okay, sir.
So you can notice that everything is linked with the whole holistic way. There's the cash flow, the discount rate, the beta, everything is linked to this.
Sir, it was an excellent session. Can you also suggest any reading on these formulas and in detail? Because many of the formulas I have not seen earlier, and it has gone above my head.
Don't worry, that is why I have not discussed at all on formula. Because if I start deriving, you will literally lose your interest. So objective is everything can be modeled in Excel, or some programs. So unfortunately, no database agency provides results based on this. So you can only derive based on using Excel. But yeah, I'll recommend a cost of capital by Singh and Pratt. You can use that. That's a very good book, only on cost of capital.
Okay. Sir.
Unfortunately, this gentleman died in COVID last year. He's legendary. In US, if you are in court and if the judges will ask you, have you read Pratt? You say no. They said go out. There's no purpose of being here. So that's the kind of authority it commands. His book name is Cost of Capital by Singh and Pratt. SHANNONPRATT. Singh and Pratt.
Sorry, could you repeat that?
SHANNON, Shannon Pratt, PRATT. There are a number of books, but Cost of Capital is the one which you can buy it.
Sir, can we have your answers on the poll questions also now?
I've sent you the answer. Shilpa, if you can see that.
But people would like to listen from you.
So I'm. Where is the question?
I have shared the result. The first poll question is characteristic line is used to estimate.
So you've seen that in my my deliberation, the characteristics line or regression line. How do you get a characteristics line? When you plot return on of the Sensex or Nifty on x-axis on x-axis and return on security on y-axis. So that gives you a beta. Is that the question? So the answer is beta.
Okay. Okay, thank you, sir. 1 second. Next question.
I've seen there large number of people have answered there. Then the total beta answer 53% is the correct one. Is a relative measure of total risk. right? Because you've seen the formula sigma I divided by sigma A. So it's not a absolute measure, it's a relative measure of total risk. So that's correct. A. Next. Now, which one requires a multiple regression? You've seen that some beta requires 54% correct. So I'm done my job. So it's correct, absolutely right. Now, a lower sample size in a calculation of beta would result in a higher standard error. Absolutely right, 81% correct. So I don't have to comment on this. Beta is the slope of which straight line? So beta is the slope of, now here you made an error. Slope of security market line is RM minus RF. That is a market risk premium. Characteristics line slope is beta. So only 23% correct. I'm sorry. So if the tech company dominate the index, the beta of a manufacturing company would be higher, would be lower. 40% answer is correct. Would be lower because correlation coefficient will be lower, and therefore you require a more company specific history. Yeah, very nice. Which one of the following is an example of an adjusted beta? Bloom beta, Wozniak beta, and both. 69% is the correct answer.
Yeah, thank you so much, sir. On behalf of Bangalore Valuers Association, I request Bhuna Raman to formally convey vote of thanks for today's speaker.
Am I audible?
Yeah, you are.
Yes.
Yeah. Rajiv ji, thanks a lot for your session. This was more a sensitization session for the group. This is a very serious group. As you saw at 7:30,
yeah,
we all sit and we try to understand. So we really wanted you to come and give your thoughts, because we will already, this whole group is very geared up group. So the moment they see all your things, now we get even more worried that we know nothing and we need to buck up and we need to really work hard to understand your sessions. It has never been enough for us. Every time we finish your session, we feel that there's something more to learn, So today also it was the same way. But we really thank you for sparing your valuable time and giving us so much of insights on beta. This one topic itself is so much for us to learn. Thanks a lot for your presence and enlightenment to the entire group, sir. Thanks, Shilpa, for organizing this session for this group. And all the participants as well. Thanks a lot for being present and asking so many questions, and as usual, making this session very vibrant.
Rajiv sir, please share the PPT. People are also requesting for recording. So PPT and recording are really sought after in today's chat discussions.
Yeah, I think I'll send you a PPT by evening, because I'm just rushing to a meeting.
Yes.
Thank you very much for all people who have joined, and Bhuna ma'am, thank you very much. And Shilpa, you made me, basically very serious, as he said, to come at 7:30 to deliver a lecture is not an easy job, but then, okay, fine. I'm used to the evening, not in the morning. Thank you very much for all your efforts, and you forced me to prepare questions, this and that. So I think it was all great goes to you. So to extract maximum from anybody, you know better how to get that. Thank you very much. Thank you very much. I really enjoyed and enjoyed the company of all learned participants. I hope when I get next opportunity, there'll be a more learning opportunity for all of us. Thank you very much. Thank you very much, everybody.
Sure, sir. We'll trouble you again after some time on some litigation session.
Thank you.
Okay, sir.
I can
Thanks
see
all.
you. Surely, ma'am. Thank you very much. So it's a complete Bangalore, more focused people. Thank you.
Okay.
Thank you very much, sir.
Thanks all. Have a happy
My
week.
pleasure. My pleasure.
This is the classic example of one needs to be Arjuna to understand what is happening and what Krishna is telling.
I have a request. I think Mr. Ganesh Ramani should actually take a session. This session was little fast for some of us or most of us. So I think Mr. Ganesh Ramani should I think he could catch a whole lot of things. I'm not very sure whether he's still in the meeting, but if once the PPT comes, maybe he can go a little slow and explain more in detail. And maybe this the entire PPT will require I know definitely more than one session, more than one session of 1.5 hours or 2 hours. Anybody agrees with my thought process?
Yeah, definitely. We need some more sessions on beta, especially the types of beta and the kind of formulas that are used to calculate beta. To understand that particular formulas, it is necessary. Theory, we do know what beta is, but at an international level, definitely it will require more.
Shilpa, Mr. Venkat Gangadhar is very competent to handle this as well. I do not know about Mr. Ganesh, sorry, but I know that for sure Venkat, because he was also there with us on this session and he was able to contribute quite
he was also one of these, speakers.
Yeah, so maybe this session, if we can run through with Venkat also, it would be good along with Mr. Ganesh.
Why don't we target, now that since we are on this, why don't we target the next session, which is scheduled on June 25th to, we will learn beta itself more in depth and we'll go a little slower. We'll try and understand each of the concepts. We'll understand the practical applicability. We'll also understand, we'll go back and, get our basics right with respect to statistics, correlation, standard deviation.
I agree with Kusum, and even I suggest the same thing. We really need to know a lot about beta.
Yeah, continuation session would help, Shilpa.
Sure. I'll approach Mr. Gangadhar and then confirm.
Was Mr. Gangadharan there in this meeting?
He's there.
Not sure whether
but he's
he's
slightly
hearing.
unwell, so I think maybe he's slightly unwell. He was down with COVID. I'll talk to him, Shilpa. If you have his number, you can directly. He's done one session for us already, right?
Yes.
You could talk to him and ask him. He will definitely do. He'll accommodate.
Sure. And I'm really thanks to Bhuvana for, she has chosen this topic for all of us and she approached, the speaker and taken his concurrence before I spoke to the speaker. So I'm really, grateful to Bhuvana.
Thank you so much, Bhuvana. It is, it is just the tip of the iceberg.
Correct.
We have a lot to understand.
Yeah. In Tamil, we say, Yan Petra Indam Bergai Vayagam. So we were all so stuck with all this, whatever he taught us. So I decided this group is so serious. All this should be unleashed on you also.
Good.
What is the translation, Bhuvana, of whatever you mentioned?
That says that whatever happiness that you derive, the whole world should also derive. That's the meaning.
Oh, very, very apt for this session.
Yeah, great.
Yeah. Thank you.
Thank you, Bhuvana. Thank you, Shilpa. Thank you, BVA team. Thanks a lot.
Okay, thanks all. Bye for now.
Bye.
Thank you. Bye-bye.